Recently, Rachel Reeves has spoken publicly about encouraging more people in the UK to invest, highlighting the fact that relying purely on cash savings may not be enough to build long-term wealth. Naturally, that brings up a common topic I like to discuss on this channel, the FTSE 100 versus the S&P 500. When exploring investing as a UK investor, these indexes are likely the first two you come across. And while Rachel would probably be happy to see more money flowing into London-listed companies, I want to take a completely objective look at how the two indices stack up. As always, it's worth remembering you can't invest in an index directly, but we can invest in funds that aim to replicate the performance of an index. Both the FTSE 100 and the S&P 500 are important barometers of their respective markets. For those who believe in diversification and index investing, funds tracking these indices might be part of your overall portfolio for decades. Even if you prefer picking stocks or using more specialized funds, I think it's useful to take a macro look every now and then at these market cap weighted indexes. And in 2025, we've seen something that investors are not used to seeing. That is the FTSE 100 outperforming the S&P 500. On a year-to-date chart comparing a GBP-listed S&P 500 ETF to a FTSE 100 ETF, we can see that the FTSE 100 is up by 17.1% compared to just 1.54% for the S&P 500. The performance of an S&P 500 ETF for UK investors has been partly dragged down by the strengthening pound against the dollar, but even taking that into account, there has been some clear outperformance so far this year. If we zoom out to a 5-year chart, we can see that a FTSE 100 ETF has underperformed, but I bet the gap isn't as big as you would expect. It does seem this 5-year period has been relatively good for the FTSE 100. Now, of course, I'm the first to say that judging any index off just 8 months of performance or even 5 years is pretty silly. We always have to remember that past performance doesn't guarantee future results, and if we zoom out one last time, we can see that over the maximum comparable time period for these ETFs, that the S&P 500 fund has smashed the FTSE 100. So the result you will see will always differ drastically depending on the time period you look at. I also recently covered what I think of looking at past performance charts in general. In summary, it's not very helpful at all. You can check that video out to hear my thoughts. That being said, I do think this recent good run for the FTSE 100 makes it another interesting time to compare the FTSE 100 to the S&P 500. What are the differences? What are the pros and cons of each? Which one makes a more tempting investment opportunity, etc. So that's exactly what we'll do in this video. Remember, these videos are not investment advice and are made for informational and entertainment purposes. I'm not a financial advisor. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. If unsure about anything, consider consulting with a qualified financial advisor. First up, let's look at valuation, because one of the most common things you'll hear is that US stocks are expensive right now. There are a few ways to look at valuations, but let's start with the forward price to earnings ratio or forward PE. To understand what that means, we first need to look at the standard PE ratio, which takes a company's share price and divides it by earnings per share, usually over the past 12 months. This is something called a trailing PE because it's backward looking. A forward PE, on the other hand, uses projected future earnings. Since markets are priced based on expectations, not what's already happened, I personally find forward PE much more useful when comparing valuation levels. Now let's look at the numbers. According to this chart from Yardeni Research, the forward PE ratio for the S&P 500 is currently 22.5. That's significantly above its long-term average of 15.9, and actually back to levels we saw in 2021, before the tech sell-off of 2022. So yes, based on this metric, the S&P 500 does look expensive relative to history. Now, what about the FTSE 100? Unfortunately, I couldn't find a chart specifically for the FTSE 100, but Yardeni does track the MSCI UK index, which is very similar and covers 85% of the free float adjusted market capitalization in the UK. So it serves as a very good proxy here. According to that data, the forward PE for MSCI UK is 12.9. Whilst there's no average line on this chart, this looks slightly below its recent historical range, which may suggest that UK equities are still relatively cheap, even after recovering from their extreme lows after the Liz Truss mini-budget in late 2022. To add another perspective, however, Vanguard's 2025 Economic and Market Outlook suggests that both UK and US stocks are considered to have stretched valuations, but US equities significantly more so. Now, stretched here doesn't mean that a crash is imminent. Valuations can stay elevated for a long time. But it is a consideration and perhaps something to know about, even if you don't take any action from it. Going back to forward PE ratios, one of the clearest ways to visualize the difference in valuation is by comparing the top 5 stocks in each index. Let's take a look at their forward PE ratios based on 12-month forecast rolling data from Stockopedia as of 20th of August 2025. The S&P 500 top 5, we have Nvidia, Microsoft, Apple, Amazon, and Meta, with PE ratios ranging from 25.6 all the way up to 33.3 for Nvidia. And then for FTSE 100, we've got AstraZeneca, HSBC, Shell, Unilever, and British American Tobacco. PE ratios ranging from 9.1 to the highest being 17 for Unilever. The valuation gap here is very clear, but so is the difference in the types of businesses that we're looking at. On one side, you have high-growth tech companies with dominant positions in AI and cloud computing. On the other side, a pharmaceutical company, a bank, an energy company, consumer staples, and a tobacco company. So based on this, is the valuation difference justified? That's up to you, but it's fair to say we're not comparing like for like here, and we'll explore this further in the next section. But before we take a deep dive into the index breakdown, I'd like to thank XTB for sponsoring today's video. XTB have been around for a while with over 20 years of investing experience, but they are a relatively recent entrant in the stocks and shares ISA space in the UK, and it's great to see a super competitive offering. Their ISA has no account opening and maintenance fees, as well as zero commission on stocks and ETFs, making it one of the cheapest ISA providers in the UK. With over 7,500 plus stocks and ETFs to invest in, there's also plenty of choice to suit every style of investor. The ISA is also flexible, which means you can withdraw flexibly and reinvest within the same tax year without impacting your ISA allowance. The interest on ISA-free funds is also really impressive and is currently tracking the Bank of England base rate at 4.25% AER at the time of recording this video. If you're looking to get started investing or looking to move to a new provider, you can check out the XTB ISA and all the further details via the link in the description. Thank you again to XTB for sponsoring today's video. So we briefly looked at the top 5 constituents of each index to highlight the valuation gap. But now let's zoom out and take a close look at the overall composition of these indices, starting with a side-by-side comparison of their top 10 holdings. Now, just a quick note, the exact order of the holdings may look slightly different to what we saw before, as these screenshots are taken from ETF holdings as of the 30th of June 2025. Exact weightings will constantly fluctuate given the share prices of companies always change too. Regardless, the takeaway point is the same. We're comparing a tech-heavy index to a tech-absent index. In the S&P 500, the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla, they dominate the top 10. These are the companies leading in AI, cloud computing, and general innovation. In contrast, not a single tech company appears in the FTSE 100's top 10. Instead, you'll see firms like Shell, HSBC, AstraZeneca, and Unilever, which are more traditional, mature, dividend-paying businesses. I'm not saying the composition of either of these indexes is good or bad. I'm not drawing any conclusions here. It's just an observation. But it does give us some important context when comparing performance and valuations. This pattern extends beyond just the top 10. If we look at sector weightings, the S&P 500 has over 35% in the technology sector, and that's not even the full picture, as companies like Meta and Alphabet are classified under communication services, not tech. So depending on how you define tech, the actual weighting is arguably even higher. In contrast, the FTSE 100 is so tech-light that tech companies don't even show up as a separate sector in this breakdown. They're lumped into the other category. Based on the latest data I could find, tech accounts for just about 1% of the FTSE 100. So with that in mind, we can put the valuation difference into context, and it becomes clear why many argue that the valuation difference between the two indices is justified. They're simply made up of very different types of companies. However, at the same time, you could argue that valuations are stretched, even with this composition difference in mind. It depends on your perspective and your view on how much of the future is already priced in. Let me know your thoughts in the comments. I'd love to hear your take on this. For me, the boring but probably accurate answer is that markets are broadly efficient. Everyone knows that the US is home to the world's most innovative and dominant tech companies, and the S&P 500 reflects that in its valuation. Meanwhile, there's less hype around the FTSE 100 sectors, but that doesn't mean they're bad investments. As we saw earlier, these companies have done well so far in 2025, and they often perform better in periods of uncertainty or when valuations get so low that they become impossible to ignore. In general, the FTSE 100 is considered to be a more defensive index than the S&P 500 due to its focus on mature, dividend-paying companies in sectors like energy, healthcare, financials, and consumer staples. Moving on, another stark difference between the FTSE 100 and the S&P 500, and possibly a key source of appeal for the FTSE 100, is dividends. We touched on this earlier, and it's largely a consequence of sector composition. Tech companies, which dominate the S&P 500, typically reinvest most of their earnings back into the business for growth. That means lower dividend payouts, or in some cases, no dividend at all. On the other hand, sectors like financials, energy, consumer staples, and healthcare, which make up a large portion of the FTSE 100, tend to be more mature, cash-generative businesses. They may have fewer growth opportunities, so they return a larger share of profits to shareholders in the form of dividends. As a result, the difference is significant. At the time of recording, the FTSE 100 offers a dividend yield of 3.32%, compared to just 0.98% for the S&P 500. So for investors who are actively seeking dividends, whether it's to actually draw an income or just due to behavioural preference for receiving dividends, the FTSE 100 is the clear winner on this front. It's important not to overlook how much of the FTSE 100's performance has come from dividends. If you weren't reinvesting them, the total return over the last decade would look much less impressive. This is why it's always better to look at total return, not just price return. Ignoring dividends gives you an incomplete picture of an index's performance. The charts I showed at the start of this video were of course with dividends included. That said, as we are keeping this video objective and covering both sides, there's a counter argument here in favour of the S&P 500. If your goal is to maximise total return, then how that return is delivered, whether through capital gains or dividends, arguably doesn't matter. It's all still return. So if the S&P 500 is able to deliver stronger growth over the long term, then its lower dividend yield shouldn't necessarily be seen as a disadvantage. You can always sell shares to generate cash flow if needed. There's plenty of videos out there about dividend irrelevance, and it's not something I'll dive into in this video. At the end of the day, it comes down to investor preference and personal circumstance. Some people love the psychological satisfaction of seeing cash hit their account, while others are more focused on long-term compounding and total wealth growth. There's no right or wrong, but it's another area of clear difference between the two indices, and it's definitely worth factoring into your own decision making. In conclusion, we're simply not comparing like for like here. Other than both being equity indexes, the FTSE 100 and the S&P 500 have very little in common. The FTSE 100 is generally considered a more defensive investment. That's thanks to its sector composition, lower valuations, and higher dividends. By defensive, I mean that it tends to hold up better during periods of uncertainty or when high growth, high valuation stocks come under pressure. We've seen that in action. In 2022, the FTSE 100 outperformed the S&P 500 during the market correction or tech wreck, whatever you want to call it. And the same has been true year to date in 2025 with the Trump tariff uncertainty. That being said, to be clear, the FTSE 100 is not immune to crashes. Stocks across the world tend to correlate more than people would expect, and broad sell-offs can bring everything down with them. So if you're looking for an investment that will never experience volatility or drawdowns, stocks probably aren't the right place to be. Summing up the S&P 500, it trades at a much higher valuation, but that's largely explained by the tech-heavy nature of the index and the current dominance of AI-related companies. We're in a period of significant AI optimism, and all of the global leaders in that space are in the S&P 500. So it's no surprise the index is trading at a premium. That does of course mean there's also a risk of greater volatility. If these companies don't live up to the hype, or even just slightly disappoint, there could be meaningful downside. Some commentators have stated that certain tech stocks are priced for perfection, which does simply mean that results have to be perfect, not just good, to justify their current share price. Valuation premiums always come with expectations, and expectations don't always materialize. So while many people would argue that the S&P 500 is the obvious winner based on performance over the past decade and its more exciting growth narrative today, I'd say it's not that clear-cut. There's a case to be made for both indices depending on your personal goals, time horizon, and risk tolerance. And as I always say, personal finance is personal. I personally take the pretty boring route. I choose neither and use a global index fund as the core of my portfolio. This is very US heavy at the moment due to market cap weighting, but it also gives me a small bit of exposure to the FTSE 100 and dozens of other markets. I let the market decide how much each country should be weighted, and I focus on long-term growth rather than making big allocation calls. That's just how I do things though, and what is suitable for me may not be suitable for you. Let me know your thoughts in the comments. Did I miss anything here? Do you favour one index over the other, or do you take a more diversified approach like I do? As always, thank you for watching.